All right, we are live. What's up, everybody? Spencer Israel Stock Market TV. I'm here with Jeff Macke from the Macke portfolio. Mr. Macke, you're in the thick of it right now, so I appreciate you taking time out of your busy week to do a little video with us because I know you got earnings coming out of your ears, right? It's crazy.
Coming out of my ears. Normally, being a consumer guy, it's kind of sedate. I spend a lot of time just watching things. But
Yeah.
4 times a year, Spencer, I spend about 2 or 3 weeks just diving into earnings like crazy. And that's this week. This week is probably peak activity. And we're going to hear from a lot of companies that have had, kind of a rocky year. We heard from the big box fellas last week, and this week it's more of the same, or the same, only more so. It's going to be chaos. A lot of mall stores, a lot of high vol names.
All right, so here's what we'll do for this video. We're going to start off, as Jeff said, we'll sort of talk about, we'll get Jeff's take on the big earnings reports from last week. We will look ahead to some of the big reports from this week. And then I want to ask Jeff about M&A because if you've been paying attention, you may have noticed there's a lot of M&A going on, specifically in the retail and like food consumer packaged goods space. We had another deal this week with Pete's Coffee and Dr. Pepper. We had a deal last week with Guess. There was Skechers a few weeks back. There was Nordstrom a couple months back. I'm sure there's more I'm forgetting. So I've asked Jeff to compile a list of companies that he thinks are prime takeover targets. So we'll go over that after the earnings. After the M&A stuff, we will talk about the Macke portfolio, the Macke index, what he unveiled last week. And then last but not least, Jeff is going to tease what his big idea is, his one big idea for the rest of this year, his best idea for the rest of 2025. And we are approaching Q4, believe it or not, Jeff. So we only have I guess 4 months remaining in the year. So this is your big idea for the final 4 months of the year. So that's the plan. Jeff, are you ready?
I am entirely ready, born ready,
Okay.
and even more so right this moment.
Let's start with some earnings report cards. Last week, you always say that Walmart kicks it off, and they did. And it was didn't they miss? Technically, they missed for the first time in I don't know how long. But what is
Couple
your take?
years,
Yeah.
that got the headline. That wasn't really the story. I don't think.
Okay.
But it's fine.
What was the story? You tell me.
The story really was this is a company that's executing. They're seeing some inflation, but they're picking so much share off of Target and really everyone else. Walmart's executing incredibly well. They're a group of really smart guys, and they're kind of tariff proof, or at least they have been. What the market heard when Walmart reported and what happened to a lot of these numbers, or a lot of the stock price action, was that margins are coming under pressure in the back half, that the inflation's coming through. You and I talk about this all the time, but it's the impact of inflation. And the idea was that it took a while for the goods to get into the stores. Walmart says that A, their low-end consumers are buying less, and B, inflation's going to be hitting us in the second half. It doesn't really matter to Walmart. Walmart's going to be fine, but it just is worth keeping your eyes on. Again, what's important about Walmart is they're the best economic tell. And they're telling a story that inflation is actually on its way, whether they want it to be or not.
Okay, so all in all, pretty good though.
Pretty good. They're an exceptional company, and they turned it in. We grade on a curve here. I expect more from Walmart. If Target turned this quarter, and it would be like an A with 9 pluses, but Target did not.
Well, speaking of Target, we know that we know what the headline was, right? New CEO, and that doesn't happen every day. Right. How long had Brian Cornell been there for? What, 10 years?
He's been there for 11 years. They've been there for 11 years.
So you don't get new CEOs at companies of Target size all that often. So that was, of course, the headline. But beyond that, Jeff, what didn't you like here?
Target's kind of a mess. And the problem with the CEO wasn't that he seems like a bad guy. He seems incredibly qualified to run Target. But boy, running Target, that's not necessarily the compliment that it was, say, 4 years ago when people loved Target and Target was executing really well. The store's lost. And what they needed was someone from the outside to come in and kick them in the ass. And this was more along the lines of things are going to be the way they were before. There were a lot of thank you speeches on the calls, just kind of tone deafness that you can actually see in the stores. in contrast to Walmart, I mean, this is Target's become a feeding trough for TJX and Walmart and anyone else that's making fashion goods, just for market share. And that doesn't show any signs of reversing right now. Now, is that bid into the stock? The stock is one of those cheap for a reason type of things. And normally with an outside CEO, we talked about it, this could be like $120 stock just in a second because no one has a lot of confidence in the direction they're going, which is why bringing a guy who's been there for 25 years into the fold, into the corner office, it's like how much has he had to do with a lot of the missteps that have left Target where it is, which is negative comp store sale country at shrinking margins.
So the stock closed down 8%. All right. The day they announced this. So I guess that's Wall Street.
It dropped 10%. They kicked the crap out of the new guy. It was like a prison movie for a while. I mean, it just was they took a bar of soap to the new inmate and it got pretty ugly, but enough is enough, kind of like let the guy screw up a little before you take it down another 15%. Target act with as much bad news as in this, you get a grace period if you're a new guy and he'll be rewarded for really kind of just activity. He's got to go in there like Mike. He's got to kill some people. He's got to make some changes, and that'll reassure the street that he's not just going to be a lackey for the last regime, because no one really thinks that much of the last regime at this point.
All right, let's give him some time there. On the other end of the spectrum, from a D to an A, why is TJX so good?
Because they are absolute murder bots. Murder bots. Best quarter that you're gonna hear. I mean, it was my top pick last week in this very space. Just for the week, if you were trading them, the stock, popped and it kind of sold off because it's really a hard retail space in general. But what they did was they executed everything. Target came out and they said, "Oh, we got these macroeconomic headwinds." We heard that from Chipotle, who says, "Oh, our consumer was confident in May, but not very confident in June." What the hell are you talking about? TJX just came out and they said, "What we did is we made attractive goods and we sold them at really affordable, kind of surprisingly affordable prices. And people came to the stores. Go figure. It's just quarter after quarter of this from these guys. You'd never get an entry point in the stock. You're always sorry that you don't own more. That's actually a 3-year chart. This is just kind of what they do. It's all they do. And that's really good. It's worth a lot of money.
All right. What about Kohl's here?
Kohl's has been a shock. Remember, you and I were laughing at them. They had that pop that day that it went from like $10 and it traded at 20 at the open. And it got sold.
That was a fake, if I recall, a fake takeover report, right?
No one really it was just like, what the hell happened there? And no one came out and played the role of Snidely Whiplash with the confirmed takeover rumors. But man, people were buying into it. Expected that to go right back to nothing. It's not. It's up 88% from the lows, which is incredible. The chart doesn't actually look all that bad. It's beaten down. There could be an M&A angle. We're going to talk about those names in a little bit. But this is another one of those companies. Macy's reports tomorrow. It reminds me of the same, where they turned down takeover offers much higher than where the stocks are now. And with rates coming lower, all of a sudden it's like, what is the sum of parts here? And if they can stay in business, my gosh, Kohl's reports this week. I've been beyond skeptical on the name, but like a lot of other of the retailers, as you see the potential of rates coming down, that changes everything for these guys with debt. It changes their whole model. And all of a sudden, if they're making money, well, it's not going to zero, so it might go higher.
All right. Not going to zero, might go higher.
I mean, it's got huge short base. Yeah. Just speaking of which, here's Abercrombie.
Yeah. So they also report Wednesday morning, right?
Yep. It's Wednesday and Thursday are honestly just going to be bonkers. It's like a Woodstock palooza. I'm caffeinating already. I'm in training. I'm fasting. I'm going to be in the best shape of my life by Wednesday morning because I'll have to be. This is one there that Abercrombie's been so beaten up. Another one where they reported really kind of good numbers last quarter. The stock got up to 100. And if you bought it there, you got kneecapped in the cruelest way. I think it closed like up 2% or something for the day back in the 70s. So it just had this incredible spike. And like Kohl's, you kind of wanted to leave it for dead. Also, like Kohl's, it's not dying. And this is a really cheap company with pretty low expectations. You got 3% comps expected. That seems doable in light of what Limited did. Abercrombie itself is expected to be not very good, but Hollister, the sister company that's actually bigger, is going to be good. You don't need much. It's 10 times earnings at this point. It's just kind of sitting there being cheap and everyone expects it to fold. It's not folding. And from what I hear with back to school, pretty good. It's Walmart itself. Another, again, who are you going to argue with Walmart? Do they know about back to school? Yeah, because $2 billion a day in U.S. retail. They say back to school was pretty strong, bodes well for the holidays. It certainly bodes well if you're Abercrombie and Fitch selling stuff to a bunch of kids that go to school, teenagers, high school kids. It looks cheap, breaks through 100, that thing can go to 150 and still only be retracing about half of what it's lost.
So Abercrombie's at 99 right now. It sounds like 80 would surprise you more than like 120.
Much more. It's again, the expectations are really low. It's priced for 10 times earnings for a reason, and that's because they think the word on the street is that Hollister is kind of been over earning and Abercrombie's in trouble. We've talked about denim a lot. There's another name that if you're selling kind of T-shirts and denim to a bunch of teenage kids, this is a really good time in your life right now because denim is on the surge.
All right, what about DG? This stock has been on an absolute ripper, and they report when Thursday.
Yeah.
Okay.
And just screaming. It's been, if you look at it this year, this is one of those where you don't want to go back too far on the chart because things get a little ugly if you widen the aperture, if you will, to quote Cracker Barrel. But it's been a huge comeback year and kind of hard to see this coming. It's like the whole tariff war thing has been pretty good for people that sell a bunch of really cheap stuff, largely that's imported from China. Dollar General, of course, obviously has a grocery component to it as well. They cleaned up their stores. Another story where you build expectations down as low. You take these stocks off 66 something %. You throw in a merger or two, and everything looks the most dire. But these companies that have room to invest and just give them room to run, they outperform. And so Dollar General, it's just quarter after quarter, and people keep being surprised by it, despite the fact that they've had a huge year. You can see the last earnings. You can see the earnings last time around. Yeah, they surprised the upside, gapped higher, stayed higher, and so that's nice price action. It's good action.
So bias to the upside for DG.
Bias way to the upside, okay. Way to the upside. I don't think you're going to need an island reversal there.
All right, let's do a couple more here. Looking ahead, so this is the gap. Which that is a big gap on the chart there. Bias to the upside or downside here?
Upside. Denim recovery, better than expected traffic, which is kind of surprising. 3.6% traffic according to Placer AI. That usually leads to comps around the same number. Comps of that number at the gap would be bought as a stock, and a huge quarter for Richard Dixon, their CEO.
What about Urban Outfitters?
The Dollar General of them all, I dare say, only even better.
General of them all. What does that even mean?
I just, in terms of just low expectations meet really, really good execution, and that's about where the similarity ends. Urban is just a cool mall store. They're really good merchants. They have so many different ideas. At one point, they had pizza ovens going in their stores.
I remember
that didn't work out, but they tried crazy crap. They're going to be my best bet. If you're looking for a beat and guide higher, it's going to be Urban. I just feel like back to school is good. They sell a ton of different stuff through different labels. High-end customer, their kind of mid-high-end customer has been super strong all year. I'm kind of looking forward to Urban. I kind of wish I owned a ton of Urban, but that life is what it is. But everyone else, keep your eye on it.
Wow. Let's summarize all of this. Put all this together for us.
Most likely to beat. There's too many to go over it. But you got Urban, A&F, Dollar General, most at risk. Best Buy, which has to kind of give a reason why we need Best Buys in the world anymore, because it's a really tough space. They have huge tariff exposure. Victoria's Secret, huge tariff exposure. The best tariff tells, if you just kind of want to get another read on what's going on with the tariff, Dick's Sporting Goods, 90% something of all sporting goods manufactured in China. So that's obviously a headwind, but they're best of breed. And Williams-Sonoma. Did you see Friday after the nice big rally? Because we're going to do rate cuts or we're going to fire every single person on the Fed board. Right after the close, that sends all these furniture stocks screaming. It's like, oh God, rate cuts. Finally. But at least people are going to be buying houses. Then after the close, they announced that we're going to start tariffing furniture just from China, which is where almost all of it's made. That crushed Williams Sonoma, but it didn't really crush the stock so much. So it'll be super interesting. Laura Aber is like one of my favorite CEOs, super smart, super straight shooter, and has done a great job with the tariffs so far. But this is just kind of a huge unknown that you put on all of these stores. I'm not sure what to make of it, but it's going to be must listen. Or I'll at least put it on the menu. If not live, it'll be certainly something I'm listening to after the report. And the absolute most discretionary, what the most discretionary item on earth, meaning the one that people could absolutely live without if they're feeling a little strapped financially. Take a guess.
Well, I can see what it says right there. So
it's a costume for your dog for Halloween. That's the most discretionary item on earth. If things are feeling a little tight in the wallet, you're not buying bee ears or any type of little outfit for your dog. You're not going to dress up your wiener dog like an actual hot dog. You're just not going to buy your dog a costume. They're just going to do without Halloween that year. Petco reports this week, ticker symbol WOOF, probably the best ticker in the entire stock picking universe. But that's the one that, we get to see. That's a good litmus test for how the consumers are really feeling. If it's in tough times, people cut back on pet food stuff, and we'll see.
All right, let's pivot here and let's talk about M&A. As I mentioned off the top, a lot of M&A. There hasn't been a ton of M&A like overall, but specifically in your sandbox, Jeff, there seems to be every couple weeks another headline, right?
It's super under the radar too. No one's really calling it a theme, but it's happening enough that it's a theme.
What's the deal there? Like, why?
Rates are going lower. That helps. The buyouts become obviously more attractive because most of them are financed. Plus the tariffs. The tariffs are really, that's kind of what got things going. You mentioned Skechers before. They bailed right when pretty much it's after Liberation Day. The wheels were turning and they just sold out because some of these companies just are better off private than they are public. And the mall stocks are really cheap. It's 10 times earnings at the type of prices that you don't really see in strong market. It all leads to LBOs. And I think as you're wiggling the rate tree, if you're going to force them down, you're going to force down the price of money. It makes a lot of these names kind of more attractive and sort of worth a flyer, at least in particular cases.
And you have a couple. So here's just a few, right? So I mentioned these off the top. I mentioned Guess was last week. We had Pete's Coffee, which is announced on Sunday. We had Skechers, but there's more that I'm forgetting. We had Nordstrom was a few quarters ago.
Nordstrom finally got taken over, and that's really quintessentially part of this story, right? We hear from Macy's tomorrow. We hear from Nordstrom never again because they after 10 years of just talking about it, dabbling with it, the Nordstrom family making run after run, they finally just sold out. Yeah. And that doesn't happen. Again, it's a good sign. It's bullish. These things happen in bunches. And deals that have been waiting for ages to get done are finally getting triggered. Again, it's time to start paying attention.
Jeff, I don't know if you know, tomorrow is the last day of trading for Walgreens Boots Alliance. They got taken out last year now, and they're finally going off the board tomorrow. So
light a candle, man. It's a tough day. I don't know where I'm going to get my digital alarm clocks or the other tchotchkes that I used to buy at those stores. Well, picking up your pharmacy.
So my question for you is who's next, right? Foot Locker is a good example, right? Foot Locker getting acquired by Dick's Sporting Goods. Who is next? What types of companies are we looking at that could be potential takeover targets? Obviously, we are assuming that when a company gets bought, it gets bought at a nice, juicy premium. That's good for investors. That doesn't always happen, but it usually happens. So who's next?
Premiums in the eye of the beholder, and depending on what time you bought it. And so what you're looking for in terms of what's next, American Eagle springs to mind as a group that you have nice insider ownership. It's a lot like Guess in that sense. They're going to really benefit from any type of denim resurgence. So you have 23% insider holdings, $2.5 billion, which isn't all the money in the world. The EPS is pretty reasonable. And with a denim tailwind, this stock has done nothing for 30 years. We showed the chart a few weeks ago. It basically has been trading kind of around 10 as a floor. It's right near that level now. it could be taken over, and it's probably worth more private than it is public because they still import a lot of stuff from China. That's just a wild card. That doesn't lend itself well to nice predictable quarters that reward you on Wall Street. It lends itself well to being a private company where the month to month swings don't matter quite as much.
All right, sticking with the mall here. You like Abercrombie as well, same reason.
Yeah, Abercrombie, same reason. Just put it into another. They're not getting any credit. If you're not getting any credit for being private, it seems complicated, but this thing can break up into two stores. Hollister and Abercrombie, the name brand, are just almost exactly the same size in terms of revenues. Usually one of them's working, the other one's not. And normally that's been rewarded in the market because that's the idea of having a conglomerate, right? It's one picks up the slack when other things they're kind of counter-cyclical to each other. These things were born to be broken up. It's the deal kind of writes itself. You buy Abercrombie, you sell off Hollister, and you're done. And you basically paid for it. It's at 10 times earnings. If they do go to 80, I think you'll see that as the type of thing that, if they disappoint and surprise me much worse than I think, what I suspect is you'll start to hear that action pick up.
That's what they did with L Brands, right? And Victoria's Secret, just sell it off and be done with it.
Yeah, you did something. It just doesn't maybe make that much sense. Crocs is the shoes have just been decimated, just kicked in the face. Crocs has been hamstrung by the Hey Dudes, the unpopular cousin.
Wait a minute. I'm wearing my Crocs slippers right now.
Nice. Those are good looking, man. No gibbets.
I've had these for a very, very long time, which is probably your point.
Yeah, that is a problem for them. But it's if you just sell kind of different sizes to the kids and maybe a few gibbets. I've got my Crocs as well, and they're also 10 years old, and they're like fur covered. So you'd think you'd have to chuck them just for the stank of it, but they're unbelievably durable as advertised, right?
That's what I'm saying.
It's incredible. It's incredible. It trades for 7 times earnings. You can own the entire company for 7 times earnings. I mean, dirt cheap. Just because for reasons that kind of make sense. You got an import factor there. You got tariffs. They're located all over the world. It's a tough time to be making shoes of this type, and they last for eternity. So all those things are working against it. But people have been betting against Crocs for those reasons for a long time, and it didn't matter to the stock until we got into tariffs. And this is the kind of story that you look at Skechers, which got out of the entire shoe space at exactly the right time and stayed out. They closed the deal the second we had Liberation Day. Crocs has been trying to fight the good fight, but they just keep disappointing. And for what Wall Street's looking for, which is consistent earnings growth, they're going to keep disappointing. I mean, they don't really know. It's really hard for these guys to say when demand is going to pick up again in their space.
All right, last one. You think Peloton is a potential takeover target as well? Is that because it's cheap, or are there other reasons?
I think there's a mode of companies that came to market during the absolute zero ZERP days, the zero interest rate pay. And so you had a lot of these subscription service companies, Real, Stitch Fix is the name. I know you're familiar with Peloton. There's no one else that's going to come in and take their space. And so these companies, the ones that actually proven they can exist, and Peloton with their new management, they're well on the way to being just a cash flow positive, kind of churned it out type of company, 3 million loyal subs that are just going to pay year after year. It's never going to be a growth business again, not at least a serious one. So they're better off private. Once it goes cash flow positive, the model becomes really easy to put together for investment bankers. And you're looking at a company that you're buying quite a bit for not very much. It's never going to be a terrific public company again, even though I think the stock can easily double from here. But I think it makes a much better private company. No one's coming after them because there's not going to be any funding to do startups that would take them out. So they have a dominant share. It's always going to have a place. Is that place as huge as it looked during the beloved COVID days when Peloton reigned? No, but that's okay. It's still kind of nice to have 3 million subs that just pay every single month.
I gotta say, you're making a lot of sense here.
I do. I've given it some thought.
All right. What do we have here? So
these are kind of the targeting.
Line, if rates are coming down, it's only going to make this M&A easier. Right.
Yeah, it is the deal yesterday for $18 billion for Pete's at all the, some of these companies that you don't even think about Pete's and they just get tossed around back and forth. It's incredible but you don't need them to be that big and you don't need to overthink it. $2 to $15 billion, not that much to spend anymore. That gets you Macy's, Costco, Kohl's, or not Costco. God, Costco's they're not getting bought. Abercrombie, AEO, Victoria's Secrets, they're all super cheap. And if you can create a little FOMO, we're one or two buyouts away from all these companies becoming targets because the multiples are low. The private equity guys love to get in retail because they think the cash flows are going to work for them. And it just becomes in a world of tariffs when earnings stability is out the door. These companies, there's a lot of CEOs, a lot of ownership groups that would just rather be private. And so we got AOA, NF, Urban, Victoria's Secret, Levi's, and more. Levi's, they should never have gone public in the first place. I think they take it back private again.
All right. Speaking of the and more portion of that image there, what we've done here is really only kind of scratch the surface of the work that Jeff does. Something that you unveiled last week, Jeff, is your Macke consumer average. This is the Macke 30. This is your Dow Jones of the consumer space, or the 30 most important retail and consumer companies on the market. Tell us about this and why you felt the need to kind of create your own index for tracking the consumer side of the market.
I think the sectors are garbage. I think they're antiquated. It's 2025 and I'm Jeff Macke, damn it. So I decided to make my own Dow 30. I wanted to pick 30 consumer stocks, and consumer, I broadened that out to include stuff that people use every day. Just kind of a rational type of way of looking at this. Geez, pick one. Uber. Uber's an example of a company that's a consumer company. Now, I know it's tech. I know they're doing driverless cars. I know there's a lot else going on there. But at the end of the day, if people aren't taking it, they don't have a product. You actually, it's not Twitter where it's free. You have a situation where freaking people pay. They drive an Uber. It tells you a lot about the consumer, and no one's giving it up. That's a staple to me. That's every bit as significant as a Dow 30 company, and you got to think of it as consumer if you're in my shoes. And so we made a basket of 30 of them, and it better reflects what's really going on with the world right now.
Yeah, and this is the Macke 30. The bottom pane here is the Macke 30 versus the Dow 30, and obviously the Dow has been a bit of an underperformer really this entire cycle. But no real surprise. If the Macke 30 index has Amazon and Apple and Meta and Walmart and Netflix, right, and all these outperformers, no real surprise then that they would outperform the Dow 30. So you're doing this as part of your work at the Macke portfolio, right?
Yeah, absolutely. And I'm sharing them the ideas that I want to take advantage of trends, but first I need a baseline. First, I want to see exactly kind of what's going on in consumerverse without just throwing in these ETFs that are just horribly imbalanced one way or the other. They're either way too balanced where they give the Kohls of the world a 2% weight, or they're just out of balance because Tesla is a discretionary and they count it at freaking it is 20% of the index. So we're starting from scratch and we're making the names that consumers really, really use, and the levels at which they use it represent what's happening in the world. 30 of them, Spencer.
So this is really just the tip of the iceberg, though, and we'll actually share a couple more in a second, because you have, how many indexes have you built? You've built probably a dozen at this point, and I guess, Jeff, what is the purpose here? Like, why should we care that you made an index, or why should we care that?
Because that's where the alpha is. It's I don't think that all retail is going great right now. I think it's a stock picker's market, but that's a cliche that doesn't make me crap for money. I think denim's doing well. I think denim's doing well at the expense of athleisure. So I want to set up baskets that I can race them. I'm going to give people indexes where. Listen, how do you take advantage of the denim trend? Well, I tell you what, it's going to be a big deal. You start with knowing which companies need to go into that index. Did you know that American Eagle Outfitters is a dumpy little retailer that is the fourth largest seller of denim in the United States, Spencer? That's the kind of stuff that we're looking for. And you can put them together. And once you parse these names and start basking them up, you can take advantage of trends in a much more granular way that allows you to create a little alpha in a world where, hey, the consumer is lousy, but not everywhere.
I guess what you're saying is, like, if you thought I'm going to go look at the retail industry, and you pull up XRT, the largest retail ETF, that is just a terrible proxy for understanding what is really going on in retail right now, right?
Absolutely. It's beyond flawed. It's just downright misleading. And beyond that, the advantage of creating more of them as you go along is you want to chop that up and figure out better ways to trade it, better pools of capital to take advantage of the trends you see.
So Mackie, the Mackie 30 and all of Mackie's indexes and all the trades that come from those indexes are available to members of the Mackie portfolio. If you are watching on stockmarkettv.com, the link is below. If you're watching on YouTube, their link is in the chat and description. If you're watching us on X, I just retweeted this tweet with the link to get access to all these. And it's not about so much the indexes. I mean, the indexes are cool, but the indexes just create a sandbox, right? And the sandbox is where you want to play to find the winners, right? Like the winners are not going to come from the middle of nowhere. They're going to come from one of Jeff's indexes, right? That's how he knows, like you said, where the alpha is and where it's not. So get monthly or an annual to get access to Jeff's picks. You get, what do you get, Jeff? You get the portfolios, or the portfolio. You get the indexes. You get new buys and sells whenever you're making them. I think you said you're gonna make a new buy this week.
I've got
Next week,
cash in
perhaps?
the model portfolio has cash right now. I'm shopping, Spencer. I'm
Yeah.
absolutely shopping for my favorite pick for the end of the year. I'll share it with members. They'll be the first to know when I'm getting long. I'm looking for an entry. I'm like a dog when you drop a ball and at the end of a dock. I'm kind of whimpering at it, and I'm about to make a pick, and I'm pretty excited about the name.
You get access to Jeff. Jeff does a weekly video that is not this, and it is just for members, where he reviews what's in the portfolio, what he's thinking about buying, what he might buy next week, what he's thinking about selling, and then what he actually does with it. That's all in there for the members of the portfolio. And I mentioned the indexes. You've got, I don't know how many, Jeff, maybe a dozen at this point, but since you mentioned denim, we'll bring up the Mackie denim index. We're not going to say what is in this index. That would be for members only. But here is the denim index. And if you want to say denim is hot, this is how you would know, right?
This is how you know we're putting it to the test right now. Gap's got their own freaking let's be woke denim commercial. American Eagle, of course, offended the entire world. I'm saying the denim's just doing well. That's how we made money for members off Levi. That's how we're going to make money for them this week. And I needed a way to measure it because I think it's coming at the expense of athleisure. And so mall stocks are not all created equal. Let's divide them out.
Oh, wait, where's that athleisure? Here's that athleisure chart. So denim versus athleisure. When I hear athleisure, I just think Lululemon. I think most people probably do. Just how people hear denim and they probably think the Gap, right? But there's more to it than that. But you think this trend is turning, and the chart kind of reflects that. So
Yep.
I guess you're right.
I guess I am. I don't know. You do this long enough, you watch this stuff, but it's been a long time coming. Denim is an all-time cyclical. It took a long time for athleisure just to become clothing. But once it finally did, now you trade it just against the denim, just like you would anything else.
Yeah. And so there is so much more where this came from. There's the mall stores index. There's the big box store index. There's many, many, many more indexes that Jeff has created. And he uses those groupings to find new trades for the portfolio. So again, these indexes and their holdings are updated on the regular, only for members of the Mackie portfolio. Join now, monthly, annual. And lastly, Jeff, I did mention at the top, I teased that you would, at the very least, tease us with what your best idea is for the remainder of the year. I don't know if you want to give it away right now, but I know that this company, like many retailers, reports earnings in the coming days here. I don't know if it's today or if it's next week or if it's tomorrow or whatever, but I know they're in the coming days. And I know when they report, you'll be dropping a new report to your members about this company. Why don't you describe it for us? Why are you so bullish?
I think that it was an easy name to shoot against by the Bears. It always is. It's one of the best performing stocks over the last 5 years, trouncing Nvidia. They do report this week, but the multiples are still reasonable. It's despite these incredible gains over this name that people, it's got much more name recognition than it does anything else. It's like kind of ColecoVision or it's Beanie Babies. People are like, oh, they still exist, and it's like, no, not only do they exist, it's a public company. It's one of my favorite holdings. I gave it to members at the beginning of the year. It's having a great year. I own it in my own account, and I'm adding to it in the model portfolio. So no, I'm not going to give it away until I make that purchase because I don't want people pushing around and front running me. That's but fair. It's I think they're going to outperform. I think better than expected is the phrase that pays. And what's more, it's a little Christmassy. Today's Pumpkin Spice Day, Spencer, which many people consider the beginning of the holidays. And so happy pumpkin spice day to you. And to members, we're just going to tease you a little bit. And this name, the Bears are frankly betting against Christmas. And I'm not in the business of betting against Christmas, Spencer.
If only it was for Soho. If only it was Labubu. I don't think it is.
No, no.
If only it was. But Jeff, you brought up a good point that the stock has A, you gave it to members at the start of the year, and B, it's had a great year, and C, it's still your favorite for the end of the year. So it's not as if, oh, it had a great run, I'm taking some profits. No, you want more.
I want more. I'm getting greedy. I'm getting greedy about it, and that's okay in this particular venture.
All right, so you'll drop that analysis after the earnings report comes out. You said tomorrow. That'll be just for members of the portfolio. So again, if you're watching us on stockmarkettv.com, just scroll down. The link to sign up is on that page. If you're watching on YouTube, check out inside the description or in the chat. And if you're watching on the platform known as Twitter or X, whatever you want to call it, check out the retweet. I retweeted directly to the page to sign up, get access to all the indexes, all of the portfolio trades when they happen, the weekly review, and actually access to Jeff. I didn't even mention that. You get access to Jeff. You can email him, ask him questions. That's all part of the plan. So, Jeff, I know, like I said, I know it's a busy time for you. It's kind of like your Christmas because it's the last earnings season before the holidays. So it's kind of everyone's last chance to get their last pieces of commentary out there before the holiday shopping season. And I know the holiday shopping season kind of starts, I guess, in the coming weeks.
Tuesday starts Tuesday. The day after Labor Day is the traditional start of the holiday season, Spencer. I've declared it such.
Okay. Well, you know what that means? That the last 4 months are it's Jeff season is what that means. So special offer for new members. This offer ends on Tuesday. It's being run through the Labor Day holiday. So you have a couple of days and then the offer is gone forever. Check it out. And Jeff, you'll be busy the rest of the week and next week with turning out a lot of content and a lot of report cards on these earnings reports. So we appreciate your time and keep on keeping on.
I will, man. Thanks to everyone. And thank you, Spencer.
All right. Adios.